Love this podcast? Support it and sponsor today. Simply head to ozcastnetwork.com for details.
The information contained within this podcast does not consider your personal circumstances and is of a general nature only. You should not act on it without first obtaining professional financial advice specific to your circumstances.
Paul Atherton is an ex-Wall Street advisor on a mission to help young people win back their financial power, wealth and security. He does this by helping them understand the hidden world of finance, risk and investments, helps them figure out how it impacts them, and to seize the opportunities to make it work to their advantage. This is Paul Street Journal. Thanks for coming in, Paul. I just had a really quick question. I actually don't know what a bond is. Could you explain that to me in a bit of detail?
Oh, that's a great question, Tim. What is a bond? I mean, we're often talking about what equity or a stock is, but very rarely do we talk about bonds. And bonds are very important, incredibly important. They're a lifeblood to the global economy. And let's talk about the official definition of a bond. It's a debt instrument issued by governments, corporations, and other entities in order to finance projects or various activities. And that sounds like a mouthful. It certainly is. And that's the technical definition. But we can break that down a little bit. So let's do that. So imagine you're a corporation or a government and you need money to do stuff. Governments might want to build bridges or airports or fund education or hospitals, that sort of thing. And a corporation might want to expand, build a factory, start a new research and development project. And to do this, it takes money, and you need that. You don't need it later. You need it now. So that's for both the corporations and the government. And so raise money it does, and it raises it by issuing bond, by issuing debt. And a bond is a promise to pay, and it's an agreement with legal force. So if you look at the verb definition of a bond, it's to join or be joined securely to something. So let's go for an example. So the government issues this bond, and you as an individual, you pay for it. The government takes the money that you've just given them and invests in that airport or hospital and so on. And it will pay you back, and it will pay you back with interest. So say you put $100 into this and you gave the government $100. How very selfless of you, Tim. Well, maybe let's just for ease of calculation, we say there's an interest on that of 10%. So after 1 year, you get back your principal. That's the $100 you invested originally. Plus you get $10 of interest. That's the 10% calculated annually. Now you can imagine if it was higher interest rates for longer periods of time, and you've got the security of the government to pay you back. It's a good way of raising money for the government. It's a good way for the rest of the population at large to earn some money on their cash. Now, as we've discussed before on interest rates, if you're going to lend, you're going to want to charge an interest for that lending. And in this example that we just used, we said 10%. But how did we come up with that? Where does that number come from? Well, it comes from two factors. The first is the risk-free rate, or what you might otherwise do with the money, I call it. You could, for example, place the money in a bank or spend it the way you want to spend it or raise money the way you want to raise money. And the second is the risky rate, and that's the probability that you will get your money back. In other words, what is the probability that the entity that you lend it to will default? And for a government, not likely. So the risky rate's going to be very small. Though for some countries this has happened, so it's not unheard of. For corporations, well, this is much higher likelihood. And as I think I've mentioned before, the average life expectancy of a stock or a company on any one of the major exchanges is about 4.5 years. So default is a thing to be really thought about. So those are the two factors that go into interest rates of your return on a government bond or a corporate bond and debt. Now, bonds are an excellent stream of steady income. They're low risk, and even if a corporation were to go bankrupt, the bondholders get first out of what is left of the company. So when the liquidators come in, they sell all the assets, computers, cards, hardware, building, etc. And the equity holders, the people that hold the stock, get nothing, but the bondholders get paid first. So bonds are a great investment. They should be part of everyone's portfolio, and I highly recommend the people that are listening to this conversation, Tim, do think about investing in bonds. Thanks for your time.
Paul Street Journal.
Love this podcast? Support it and sponsor today. Simply head to AuscastNetwork.com for details.